Hello, everybody. My name is Kevin Wadsworth from NorthStarBadCharts.com. And if you ever wondered what technical analysis is, how you can use it, and why it works, then you really should spend a little bit of time just watching this podcast that I'm about to do for you. I'm going to talk you through a post that I put on the website a little while back, and it will, I think, explain for you the basics of technical analysis and just how it is that we were able to forecast what was going to happen with a whole range of different asset classes. So without further ado, I'm going to do that. I'm going to turn the screen sharing option on here so you can see my computer screen. And I'm going to turn my video camera off because you don't need to see me. Okay, so this is a post on our website and it explains how technical analysis works, really. I'll talk you through it. So it says right now there are problems with banks and with cryptocurrencies, inflation, the cost of living, COVID, negative oil prices, and so on and so on. It's all noise. The charts have the ability to completely cut through that noise. This is the chart for the 10-year yields as it was when I posted it over 2 years ago. So this is the chart I put on Twitter well over 2 years ago now. And what it shows is a very clear technical analysis pattern. What is technical analysis? Well, it's where you look at the price chart of something, and in this case, it's the 10-year yield. Government bonds. Okay, it's how much interest the government pays on its 10-year government bond, how much yield it has to pay. So it is a graph, and it shows that during the 1960s and 70s, the 10-year yield was rising. Fair enough. But then it shows that for 40 years, the 10-year yield was dropping. And as it dropped, that entire process was contained by these two lines. One's called a resistance line, that's the top line, because it resists the price passing through it. And the bottom line is called the support line, and it supports the price at various points in time. Now, in 2020, particularly during the COVID period, we pierced that lower support line. But because this is a particular chart pattern that is descending, it's moving downwards, and it's expanding as it moves downwards, it's called a bullish expanding descending wedge. What that means is that it should break to the upside, not the downside. And with it being the 10-year yield, logic would tell you that it's pretty near impossible for it to be at such incredibly low levels for a protracted period of time. So the logical conclusion was that this was a false breakdown. Now, false breakdowns from a 40-year pattern like that result in very rapid, violent upside reversals. So this forecast was, for someone with a little bit of technical analysis knowledge, a relatively easy one to do. I put these arrows on the chart and suggested that on this occasion, after several attempts to break through that upper line, because of what's happened here, the movement was likely to be violent, full of energy, and with so much energy that we were likely to pass through this around about 2.5 to 2.5% level and move on up towards 5%, which seemed unimaginable at the time, of course. These are basis points, 54 basis points, which is 5.5%. So as you get down here, it's 0.7%, 0.5, 0.4, 0.3. These are called basis points. So effectively, the interest rate was near zero down here. And as you come up here, you have to divide the number by 10 to get the percentage. So it's about 5% interest rates. So at that time, it seemed almost unimaginable because of the levels of debt. With multi-trillions of debt, then these sort of interest levels, I was told at the time by a lot of very learned economists, that it just wasn't going to happen. But the technical analysis told us that it was very likely to happen. It didn't tell us it would happen, because nothing in the future is absolutely set in stone. Technical analysis tells you what is most likely to happen. So I'll carry on reading. I don't know what the reason would be that yields would do that, or I didn't know what the reason would be that yields would do that. Very few believed me because they had a narrative to explain why it couldn't happen. I could have spent hours trying to work out a supporting story, but I really don't care for stories. You cannot trade a story, but you can trade a chart. And of course, we know now with hindsight that this is exactly what did happen. The 10-year yield broke out above the resistance line and is now up here somewhere around over 4%. And it's followed this trajectory perfectly. So the forecast was correct, regardless of all of the reasons why it couldn't happen that I was given. This is another example. In 2019, I posted this gold chart and suggested it was going to $2,000 or more before spending a long time correcting. So you can see my forecast was for it to move from over $1,500 back to somewhere around 1450 or a little bit lower, and then for a little bit of a consolidation and a rapid move up towards the 2000 area before another long consolidation that would take a number of years. Now, at the time when I did this in 2019, I was just estimating that we could get a breakout from this handle pattern. In fact, as it turned out, we did, but then the handle went on to enlarge, develop, and become what we see today. But basically, back in 2019, I was able to forecast the move to $2,000 and then a long period of consolidation. So from a trading point of view, what you would have done is bought heavily at 1500 or any price below 1500 as it came to do this back test, and then sold somewhere up here near $2,000, and then waited for this consolidation period to play out. What actually happened is that we pulled back, came back to somewhere in the region of it would have been probably around about $1,500 or a little bit less, and then the rapid move up to 2000 plus. That was the point where I'd suggested years earlier that you should sell, and then the handle formed, and we did break out. That was at the point where Russia invaded Ukraine, and it forced this breakout, which we now know was part of a move that extended that handle and made it wider and longer, because a headline generated move like that tends not to last. It's just a knee-jerk reaction to something that's going on. It's not necessarily a reflection of the fundamentals. It's more a reflection of something that's just going on, that's a newsworthy story. The precious metals market wasn't any fundamentally different just because Russia invaded Ukraine, and for that reason the price did not stay at that elevated level for a long period of time. It came back and, as we know, is still today waiting to get its confirmed real breakout. Point being, though, that this forecast was pretty damned accurate. You can see the arrows replicated here and what the price did. Now, how was I able to do that? It wasn't just a case of putting arrows on a chart. It was a case of studying all the technical evidence that's available to a technical analyst on tools like TradingView. And when I talk about technical evidence, I'm looking at distance from moving average. I'm talking about the rate of change analysis. I'm talking about all of the trend and momentum indicators that you can see on TradingView. I'm talking about the moving averages. I'm talking about the ratio charts where you can do a ratio of gold to the S&P or gold versus inflation. All of these kind of comparisons that you can do using ratio comparisons. How was I supposed to know why it would do that? It's impossible to know why. However, it is possible to follow the evidence and act on it. So back in 2019, I didn't know Russia was going to invade Ukraine. I didn't know that's what was going to cause this spike to the upside. And yet the narrative fell into line with what the technical analysis chart had told me was going to happen years earlier. All of the explanations and all of the news stories that appeared over the years as this price action unfolded were just superfluous. They weren't needed. They were surplus to requirements from the point of view of trading and investing in gold. All you needed was good technical analysis. And I have to point out that technical analysis can be done well or it can be done badly. If you're a technical analyst who has a particular bias for gold or for cryptocurrencies or for the stock market or tech stocks or whatever, then you would tend to find a technical reason why price is going to do what you already think it's going to do. But if you're completely unbiased about it, then what you do is you apply the same set of rules to every single chart that you look at. Is the price above or below the 3-year moving average? Is it above or below the Ichimoku cloud, which is another technical indicator? Has it broken out of key overhead horizontal resistance? Is it outperforming the stock market? All of these things you apply, whether it's gold, cryptocurrencies, whatever, the price of bananas. You have to apply the same set of rules and draw the same conclusions from those pieces of evidence, regardless of what the investment is that you're looking at, what the stock is, what the commodity is, or whatever. In 2020, I laid out the technical evidence that suggested silver would be likely to struggle for a number of years. Why? Because the chart said it was a high probability. I don't need a backstory. There's no need for me to dig around in news articles and find a fundamental reason why silver would struggle for lots of years. All you have to do is look at the chart, I'll click on this for you. All you've got to do is look on that chart, and what you can see is, there you go, a large arc basing pattern with an elevated price. Price had moved up in a way that wasn't really very sustainable, and the edge of the arc was, well, there's two arcs here. There's an inner one, and then the COVID low created an outer arc. So you've got a support line that is well below the current price. Price is extended, and my logic here is that the technical analysis pattern and all the evidence that I just talked about suggested that this was going to not move right the way up to $50, but that it was going to go sideways to down for a number of years. There was an 8-year cycle low due somewhere in this point as well. So there's points of attraction down here to the left and below the current price action. So it suggested to me that that was where price was going to get attracted towards. And I said at the time, don't shoot the messenger. This is just what the technical analysis is suggesting is the most likely outcome. So there we go. Once again, the technical analysis does not need a narrative. It does not need a story. It does not need any particular reason or backstory as to why something is going to do what the TA says it's going to do. So the technical analysis, if it's done properly with due consideration to all of the evidence, will show you the way effectively. When the uranium market was at rock bottom, it was impossible to find anyone with a good word to say about the sector. At the time, I posted this. So this was in 2020, post about Energy Fuels. I'll click on the chart to enlarge it for you. Energy Fuels is a uranium mining company, and you can see this breakout here from a very large bullish descending wedge, and there's also an arc type basing pattern in here as well. These arcs, by the way, they form because of investor sentiment. It's nothing, it's not voodoo or some kind of black art. It's simply reflecting cyclical behavior in investment cycles. You get a peak, and then gradually over time price bottoms. It's like day and night. It's like temperatures, from day to night. You get a high temperature during the day, then it cools off, and then temperature gradually warms up again during the morning and towards the peak of the day where temperature reaches a maximum. So there's a weather forecasting analogy for you, and that's my background, of course, is in meteorology. And all of these cycles just repeat on large timescales and also on smaller timescales. You get lots of small timescale price action that does a very similar thing to what this is doing on a scale of many years. But the forecast that I gave was that price was going to move up into this area somewhere around 10, 11, 12 US dollars, and then consolidate and then move on into zone 2. Always with the edge of the arc here as a support line, and at times you would expect the edge of the arc to be tested. And of course that's exactly what has happened. That trajectory has been followed exactly as I suggested. Immediately after I posted that, Energy Fuels moved up into zone 1 where it is now. So no narrative was needed, just technical chart evidence to assess the probabilities accurately. You have to remember this is all about probabilities. There are no certainties in any kind of predictive technique, whether it's technical analysis or any other methodology. All you can do is arrive at a range of probabilities to suggest what is likely to happen, not what will happen. So this can be applied to today's silver roadmap, and this is the roadmap up towards the $50 area. It says take a careful look at it and ask yourself, how would this chart need to be changed if a silver related news story developed? Let's have a look at it. So if I don't know, some kind of newsworthy event around silver develops and price starts to move to the upside, would it make any difference to this chart? Well, no, it wouldn't, because we've pre-identified zones 1 and 2 that the silver price has to move through in order to activate this target up here. So we've tested the middle arc there. There are 3 arcs here, and that's not cheating. It's just acknowledging the fact that there are a number of support lines that have been relevant over previous years. So we need to track all of these moving forwards. Now price has moved into the middle arc there, and this arc has to this day supported the price action. It's only if we get a market event like COVID back in 2020, some kind of financial crisis or whatever it happens to be, that we would come all the way back down to somewhere around about $17 or $18 it would be at the moment if we were to test this outer arc. So we continue to track upwards towards zone 1, and it's this $25 to $28 level that we currently need to pass through, and that's sort of the resistance zone, or it's like a force field capping the price at the moment. And if we can pass through that little force field there, then price, I'm quite sure, will react very rapidly, move up in towards this arc target area. All these other annotations you can see on the chart. This is trading volume by price on the right hand side, which creates support levels for the price, and you've got trading volume by time along the bottom here. And when price spikes rapidly to the upside or to the downside, you tend to get a spike in the volume as well. Often marks tops and bottoms in localized tops and bottoms in the price action. So hopefully you're starting to see how we can put all this technical analysis together. Oh, this red and green, these red and green splodges are what we call the ichimoku cloud, and they use current and previous price action to project support and resistance levels into the future. And you can see how price has come back to hit the ichimoku cloud, and the cloud has supported the price. It did the same sort of thing back here in 2009, and multiple times here, 2017, 18, again in 2019-20, this red ichimoku cloud acted as resistance, and the price action found a weak spot in the cloud there and catapulted itself up through that weak spot, and off it went. So that's yet another piece of technical evidence that we can use. The chart delivers its verdict as the stories and narratives blow around in the wind like the distractions that they are. All you need to know is bull market confidence remains muted until we pass through zone 1 or 2. That's it. That's all you need to know. There's nothing else that any investor needs to know. You don't need to know the news stories. You don't need to know any fundamental stories. All you need to know is what price do we need to pass through? At what point do we become truly bullish on silver? And this is what's kept us out of gold and silver throughout this entire correction on the website here. We have not taken a position in physical gold and silver in our trade tracker, or in platinum for that matter, or in crypto currencies for the same reason. We were able to identify the big picture pullback and correction that we're currently undergoing. Here's my latest Bitcoin decision aid. Oh, this is a little bit old now, of course. This post was done, when was it done? March of this year. So that's the Bitcoin decision aid. Once again, narratives are superfluous because this chart delivers its verdicts irrespective of any philosophical discussion about the pros and cons of Bitcoin. So you have to, as a trader or investor, you have to be completely unemotional, because when emotion comes into it, you make mistakes. When emotion comes into it, it introduces bias. Okay, so this is the Bitcoin decision aid. In my past career as a meteorologist, we had something called tactical decision aids. As a meteorologist at a Royal Air Force base, briefing the air crew, and they use tactical decision aids. And what that does is it takes a whole load of complicated, geeky information, often scientific, and it literally turns that into something that tells them whether they can or cannot do what they need to do. If they need to achieve mission goals that require good visibility, or light winds, or being able to see the ground from 10,000 feet in the air, or whatever they need, tactical decision aid, or for example, being able to identify enemy installations at night using thermal imaging equipment. Well, all they need to know is, can the thermal imaging equipment pick out those targets? In other words, what they need is for that target to be a different temperature to its surroundings so that their equipment can pick it out and see it. So all the scientific geeky stuff that goes on in the background to analyze the temperatures of everything on the land surface, trees, cars, vehicles, tanks, whatever it happens to be, that's very technical and scientific. But all they want to know is, can they see it at night? using night vision equipment, and a tactical decision aid will give them that answer, yes or no. That's all they need. And with this Bitcoin decision aid, all you need is a go or a no-go, yes or no. So I've simplified all of the analysis into colors: red, orange, yellow, and green. And it tells you when you can have high confidence that we're in a trending bull market. Now, of course, where are we? We're in late August, early September. Price action moved up to the moderate level here. And I've made the only slight adjustment I've made to this is 31 to 35k rather than 32 to 35k. So there's a zone here where the confidence levels that we're in a trending bull market move from low confidence to moderate confidence, and then above that zone there you go into a high confidence range, and once you're in that range at 35, 36,000, then you can talk about targets of 60, 70, 100,000 with some justification. Until then, you know, in this zone here, if you're a Bitcoin fanatic, you'll be accumulating Bitcoin. But if you're level-headed and dispassionate about it, you'll be out of cryptocurrencies completely until you get the renewed go signal. You would have sold up here, you'd have taken your profits, you'd have got in at around 10,000 when I gave the initial signal to get in. You'd have exited anywhere between about 45 and 55,000 when the technical evidence, or even when the distance from moving average became very stretched, and that would have led you to exit somewhere, you know, certainly 60, 65,000 would have been a strong signal to exit, either somewhere in this point here or somewhere in this point here. The final chance to exit came when we broke key technical support levels, and that was anywhere between about 40 and 45,000. So, you know, you would have made a good 4 or 5 times or even 6 times gain during that period in Bitcoin using those techniques, and you'd still be out now. You would not be in cryptocurrencies for investing. Trading, yes, could have traded some of these moves, but for investing, no. So, and as we know, we hit that 31,000 level, and we've fallen several $1,000s from there. We're currently sitting somewhere around 26,000, so a significant fall of 15 or 20%. So technical analysis keeps you on the right side of the trade. You do not need news stories, you don't need narratives, you don't need any kind of bias in there at all. And that's how technical analysis works. It uses a scientific weight of evidence gathering process, the same process that I used as a meteorologist, gathering evidence, bringing it all together and arriving at a probability assessment. That's all you can ever do, is arrive at a probability assessment. And you have to remember that if something is 95% likely, that still means it's 5%. There's a 5% possibility or probability that it won't happen. If there's a 5% chance of a shower, that does not mean you won't get a shower. It means you're unlikely to get a shower. And if you do get a shower, then the forecast wasn't wrong. What should happen is that if you forecast a 5% chance of a shower every day for 20 days, then you should get a shower on one of those days, because on average, a 5% chance of a shower will occur 5% of the time. The shower will occur on 5% of the time if you're assessing the probabilities correctly. So if I say there's a 75% chance of gold going to $2,000, then on 3/4 of occasions, when I give 75% likelihood, on 3/4 of occasions, that event should happen. And on 25% of the occasions, you would expect it not to happen if I'm assessing the probabilities correctly. So by assessing probabilities, you also have to accept the fact that your main expectation, what you think is likely to happen, on some occasions it won't happen, because that's just the way probabilistic assessments work. That's mathematics for you. So without getting too much into that and worrying too much about that, just take away the idea that this is all about probabilities, not certainties. But once you know the probabilities, you can use that to your advantage when you take a trade, and you just play the high probability events, and you're able to give a reasonable sort of 2% NAV risk on a trade that has a good chance of working out. Whereas with a trade that has a much lesser chance of working out, you might take 0.5% or 0.25% NAV risk. And if you don't know what I mean about NAV risk, then you really ought to learn a little bit more about risk money management. That's something that we do here on the website as a matter of routine in our learning area. We have lots of learning posts that teach our members about risk, reward, and money management, so that you can sleep at night. It means that you always know that you're never at risk of being wiped out and losing all of your investment capital. And once you've got your head around that, which shouldn't take very long, just an hour or two spent sort of understanding how we do that. And then we have our trade tracker, open trades, and our directional tracker, where we show our ideas about where we expect particular markets to be moving or particular stocks to be moving. And the trade tracker tracks specific trades with opening prices, or the entry price, I should say, a stop loss, and we put our profit limit or our target in there, as well as our position size per 100k NAV, or per as a percentage of our NAV. So all of those trades are tracked. The results are tracked and recorded for our members, and we're currently well over 70% up on the NAV, for example, and all of those statistics are available there. Our performance dashboard is there. You should be able to see that even if you're not a member. I think that's probably viewable on our non-logged in page as well, but it's certainly there in glorious detail for all the members. So if you think that technical analysis is something that you would like to understand, or something that you'd like to use, or you just want to sit back and watch us using it and kind of copy or emulate what we're doing, and use our trade tracker for your information and advice, and use the trade tracker to guide your own investment choices and decisions, then by all means take a look at the website and think about joining us. So that's really a bit of a walkthrough of technical analysis and how it works. There's a lot more to it than what I've gone through here, of course, and when you've been doing this for a good number of years, or in my case, well over 35 years now of forecasting the future in one form or another, from a scientific and technical point of view, then it gets much more in depth and detail. But as a sort of a beginner with all of this, you don't really need to get your head around all of that. You just need to understand that there is a process that you can use, a technical and scientific process that helps to give you an edge. It helps to give you a real understanding of just how it is possible to be able to assign probabilities to future price direction, price movement for stocks and shares and everything else. Okay, so I hope you found that a little bit useful, a little bit sort of educational, and hopefully if you were a bit of a skeptic for technical analysis, it's helped to just give you a little bit of a window into how and why it works. And as I say, the most important thing is to not be biased about it, be completely dispassionate about it, and approach all of your investments in exactly the same way. Okay, that's it from me for now. Thanks for watching and listening, and speak to you all again very soon. Bye-bye.